What if I told you that the silver market might be sitting on a hidden pressure point? One that could shock the entire financial system if it suddenly breaks. Imagine a market where the amount of paper promises to deliver silver is many times larger than the silver that actually exists for delivery. Now, imagine what could happen if even a small percentage of those investors suddenly demanded the real metal. That is the situation many analysts believe we are quietly approaching in the global silver market today. Welcome to Gold Silver Scope, where we break down the most important developments in gold and silver so you can understand what is really happening behind the headlines. Recently, something unusual happened in the silver futures market that caught the attention of serious market observers. In the March silver contract, the number of open contracts, what traders call open interest, was extremely large. In fact, it was many times greater than the amount of physical silver that could actually be delivered. This is not completely new, because futures markets often operate with more contracts than physical supply. But the scale of this imbalance raised many eyebrows. As the market approached the final days before the delivery period, something dramatic happened. The open interest in those March contracts suddenly dropped very quickly. Within a very short time, a huge number of traders closed their positions. It was almost as if the market suddenly decided to step back from the edge. At the same time, the silver price rally that had been building suddenly stalled. The market appeared to hit a sudden interruption. Trading momentum slowed down sharply, and the rally lost its strength. Events like this can sometimes happen due to technical trading limits, sudden market interruptions, or large players adjusting their positions. But what makes this moment interesting is the timing. During that short period when the rally stopped, a large number of long and short positions were rapidly closed. It suggests that traders on both sides of the market made quick decisions to step away from the March contract before the delivery process began. Now, here is where the story becomes even more interesting. While the March contract saw positions disappearing quickly, the next major contract, the May silver contract, suddenly saw a huge increase in activity. Open interest in May spiked significantly. In other words, the market did not disappear. Instead, it shifted forward. This raises some very important questions. Who exactly is taking these positions in the May contract? Are the buyers planning to take real delivery of silver because they need the metal for industrial use? Or are they simply financial traders who expect to roll their contracts forward again later? And on the other side of the market, who are the sellers? Are they confident they will have access to enough silver to deliver if required? Or do they believe that the buyers are only speculating and will not demand physical metal when the time comes? The truth is that we do not have perfect visibility into the intentions of every participant in the futures market. Large institutions, hedge funds, industrial buyers, and financial traders all operate in this space, and their motivations can be very different. However, one fact is clear. At almost all times, the number of silver contracts trading on futures exchanges is far greater than the amount of physical silver that is available for delivery. In many cases, the total volume of contracts represents many multiples of the actual supply. Some analysts even estimate that the open interest can represent the equivalent of an entire year of global silver production. If that is even partially accurate, it highlights just how dependent the system is on one key assumption. Most traders will never actually ask for the physical metal. Instead, they will simply roll their contracts forward into the next trading month. This process works smoothly as long as confidence remains strong, and most participants treat futures contracts purely as financial instruments. But if that behavior ever changes, if more participants begin requesting real silver instead of rolling their contracts, the dynamics of the market could shift very quickly. And that possibility is one of the reasons why many experienced observers are watching the silver market very closely right now. But the futures market is only one piece of the bigger story. At the same time, these unusual movements are happening in silver contracts. Another powerful force is developing in the background: the rapidly improving economics of gold and silver mining companies. Higher metal prices are beginning to change the entire profit structure of the mining industry. And as we move into the next section of this analysis, we will explore why rising gold and silver prices could dramatically increase mining profits, and how that could influence the next major phase of the precious metals market. Now let's move to another extremely important part of this story: the mining companies. Because while traders are watching the futures market, something equally powerful is developing inside the balance sheets of gold and silver producers. Most mining companies report their financial results every quarter. The last major reports we saw were based on a period when gold and silver prices were much lower than where they are today. That means the profits reported in those results do not fully reflect the current price environment we are seeing in the metals market. To understand why this matters, we need to look at the basic economics of mining. Every mining company has a cost of production. This includes expenses like labor, energy, equipment, transportation, and processing the metal from the ground. Let's imagine a simple example. Suppose a gold mining company produces gold at a cost of around $3,000 per ounce. If the gold price in the market is $3,500, that company is making about $500 of profit per ounce. That is a reasonable business. But now imagine the gold price rises dramatically. If the price moves up by another $2,000 per ounce, that same company could suddenly be earning around $2,500 in profit for every ounce it produces. In other words, the profit has increased 5 times, even though the company is producing the same amount of gold. This is the powerful leverage that exists inside mining companies. Small increases in metal prices can produce massive increases in profits. Silver companies can experience an even more dramatic effect. If silver was previously trading around $38 per ounce and later moves to levels like $70 or even $80, the profit margins can expand very quickly. For some producers, this kind of price movement could more than double their earnings. And this is exactly the type of development that financial analysts pay close attention to. When analysts review mining companies, they build models to estimate future earnings. They calculate expected revenues, production costs, and profit margins. But these models are always based on the price environment that exists at the time of their analysis. The last time many analysts updated their forecasts was months ago, when gold and silver prices were lower. At that time, they created earnings estimates based on those lower prices. But when the next set of quarterly results arrives, analysts will update their models again. And this time, they will be using much higher metal prices in their calculations. That change alone can produce major revisions in earnings forecasts. Imagine an analyst looking at a mining company and realizing that its average selling price for gold in the latest quarter was significantly higher than before. That automatically means higher revenue and higher profit margins. When analysts run those numbers through their models, the future earnings projections for the company often rise sharply. And when earnings forecasts rise, something very important happens in the stock market. Large institutional investors and trading algorithms are constantly scanning for companies with improving profit outlooks. When they detect rising earnings estimates, many of those systems automatically increase their exposure to those stocks. This means that higher metal prices can trigger a chain reaction. First, the metal price rises. Then mining companies report stronger profits. Analysts upgrade their forecasts. Algorithms and large funds start buying the stocks. And that buying pressure pushes mining shares higher. Now there is another interesting factor that can amplify this process even further. Some mining companies own massive deposits of gold or silver that are still sitting underground. When metal prices are low, those deposits may not be profitable to mine. In that situation, the metal in the ground is almost worthless from an economic perspective. But when prices rise, the value of those deposits can suddenly explode. Imagine a company that has silver underground that costs about $30 per ounce to extract. If silver is trading at $30, there is no profit. The metal has almost no economic value because it costs the same to produce as it sells for. But if silver rises to $50 per ounce, that same metal suddenly generates $20 of profit for every ounce extracted. Overnight, the company's resources become extremely valuable. For some smaller mining companies with large undeveloped deposits, this kind of price move can transform their entire business. Investors begin to revalue those companies based on the potential future profits they could generate. However, these types of companies also carry higher risk. Developing new mines requires large investments, skilled management, and time. There are always uncertainties about costs, production timelines, and financing. Because of those unknown factors, not every project succeeds. But across the broader mining industry, one trend is becoming very clear. If gold and silver prices remain strong, the entire sector is likely to report significantly higher profits in the coming quarters. Many companies could show earnings numbers far stronger than what investors saw just a year ago. And when markets begin to recognize those rising profits, the valuation of mining companies can begin to adjust upward. Yet even this story becomes more fascinating when we step back and look at the bigger picture. Because the precious metals sector, both the physical metals and the mining companies, is actually very small compared to the massive global financial system. And that size difference could become one of the most powerful forces shaping the future of the gold and silver markets. Now let's step back and look at the bigger picture, because this is where the story becomes even more powerful. The precious metals market may feel large when we talk about billions of dollars in gold and silver trades, but compared with the total size of the global financial system, it is actually very small. Think about this for a moment. Some of the largest companies in the world have market values that are bigger than the entire gold mining sector. In fact, a single large technology company could theoretically buy a major portion of the global gold and silver mining industry and still remain one of the most valuable companies on the planet. This tells us something extremely important. It means that the precious metals sector does not need huge amounts of money flowing into it to move prices significantly. Even a small shift in global investment capital could have a massive impact. Imagine if just a tiny percentage of the money currently invested in global stock markets began moving into gold and silver assets. We are not talking about 10% or even 1%. Even a movement of a fraction of 1% could create enormous pressure on such a small market. And there are reasons why that shift could happen. Around the world today, many investors are becoming increasingly concerned about government debt levels. Countries are carrying record amounts of debt, and that debt continues to grow every year. At the same time, inflation concerns and currency stability are becoming bigger topics in financial discussions. For decades, one of the most trusted assets in the world has been government bonds, especially large sovereign bonds. Investors have often considered them safe places to store wealth. But if confidence in those assets begins to weaken even slightly, investors will naturally begin searching for alternatives. Historically, gold has always been one of the first places people look during periods of financial uncertainty. It has thousands of years of history as a store of value, and unlike paper currencies, it cannot be created by governments or central banks. Silver often follows gold in these environments, sometimes moving even more dramatically because of its smaller market size and its important role in industrial demand. That combination, rising investor demand and strong industrial use, is one of the reasons many analysts believe silver could experience powerful price movements during certain market cycles. Another key factor to remember is human behavior. Investors often believe that extraordinary price movements cannot continue for long periods of time. When a market has a strong year, many people assume the next year will be quiet or average. It is a natural way of thinking because people often expect patterns to repeat themselves. But markets do not always behave that way. Sometimes what appears to be an unusual year is actually the beginning of a much larger trend. When major financial shifts occur, they can continue for many years before the full impact becomes clear. And because the precious metals sector is so small relative to global wealth, it would not take a massive change in investor behavior to produce very large moves in prices. That is why the developments we discussed earlier, the unusual activity in the silver futures market, the improving profits for mining companies, and the possibility of new capital entering the sector, are being watched very closely by serious market observers. Individually, each of these factors may not seem dramatic, but when they start happening at the same time, they can begin to form a powerful trend. For investors, analysts, and anyone interested in the future of money and markets, gold and silver are becoming increasingly important to watch. And that is exactly why discussions like this matter. If you want to stay informed about the real forces shaping the gold and silver markets, make sure you stay connected with Gold Silver Scope. On this channel, we break down complex financial developments into clear and simple insights so you can understand what is happening in the precious metals world. If you found this analysis helpful, consider subscribing to Gold Silver Scope and joining us as we continue exploring the trends that could shape the future of gold, silver, and the global financial system. Finally, a quick disclaimer. This content is for educational and informational purposes only. It should not be considered financial or investment advice. Always do your own research and consult a qualified financial professional before making any investment decisions.